VC investing in China. Now this is thoughtful. Hello, I'm Trevor Lai in Shanghai. Despite some early rough patches for VC-backed Chinese companies that went public on foreign exchanges, venture capital is still making big bets in China. More than 300 companies will IPO on exchanges here this year. They'll raise more than 150 billion RMB, creating some impressive exits for their early backers. Venture capitalists have always had to place lots of bets in often very young companies in order to eke out a few home runs through IPOs or acquisitions. The China factor adds complexity and uncertainty. While sectors like social media and healthcare continue to lap up a good portion of the latest deals, each has long odds for a big finish. It takes a steady hand and a crystal ball to be a venture capitalist in China today, and we're lucky to have both qualities in today's panel. We'll be talking with Chui, Gary Rieschel, and Rebecca Fannin on our panel. And William Bao Bean, Managing Director of Singtel Innovate, will share a thought or two about common mistakes startups make in their early stages. But first, with us is Jessica Shu, co-founder and managing director, operations at Affinity China. Jessica, thanks for coming in today.
Thank you for inviting me, Trevor.
Let's start with you introducing us to Affinity. Tell us about your company and some of the stages you've gone through from an investment standpoint and through to operations.
Well, the gist of it, just for everyone to understand, we are a luxury lifestyle provider for mainland Chinese when they travel overseas. The original start of our company actually dealt with very high-end travel. There was a niche that was missing in the market for more luxury-style traveling services. The only previous kind of travel services that were available were more hats and flags and tour buses. And we noticed that there was a part of the Chinese that were traveling overseas, and they were looking for something that was better. And then it evolved from more high-end travel services to much more mass affluent, using tech platforms as mobile apps, websites, newsletters to convey our services directly to our consumers. And that evolved actually into more of a financial transaction portion of the company, where we actually co-branded with American Express and actually launched a luxury lifestyle card, or loyalty card.
You have an Affinity card?
Yes.
Okay, and so how does a member get a card or use a card? Is it just like they would apply for any other American Express card?
It's right now at the moment it is a prepaid card. So they would have to go to the bank and actually exchange money to actually get a prepaid card. Eventually what we want to do with it is actually change it to a credit card format. But as you know, American Express, there's many stages that we need to go through, and especially the recognition of American Express with a lot of local Chinese isn't there yet.
Right.
So it's a brand building part right now. But because of our relationships with a lot of the brands that we previously worked with the more higher end Chinese, we can actually bring that to the more mass affluent population of Chinese when they travel. Because as you know, Chinese people love to buy things when they travel.
Well, typically when we talk about startups in China, there's a lot of focus on tech. Or there's a lot of focus on platforms. But it seems like you guys are really more of a service provider or a lifestyle sort of a hub, if you will. I mean, how did you pitch that originally to your investors? Because you did get an early seed investment from a Western investor. And how did you originally pitch that idea?
Originally, the idea was a platform, the creation of a network that expanded outside of the bamboo network. As you know, most Chinese, when they travel overseas, a lot of their advice is dependent on their friend of a friend who lives in a certain area that might be Chinatown inside of Los Angeles, for example. So there was the idea of initially of creating a platform that supported this. So when Chinese traveled overseas, they could look at real estate and use the platform. They could look at their kids' education and also look at investment choices using the platform as well. That idea became harder and harder to execute over the period of time, as we noticed.
Why?
They want a lot of stuff for most of the high-end Chinese, but they're also not very good at managing time or the expectations of other people's time to their time.
Right.
So for example, if you could plan a trip for them a month in advance, and this is what we do, we plan trips a month in advance, they'll still change the trip even to the same hour We've been on private jets with some of our high-end clients where they've changed the time on us while we're saying, basically saying, we're landing in one spot as planned, but no, now I actually want to change the location of our landing. So there's a lot of changes, and it doesn't really work with a lot of the partners that you work with outside of China, because people expect things are done accordingly by time, right? You go to a meeting at 2:30, you're expected to end at 4:30. Maybe you can go over by 30 minutes, but missing the meeting completely, that's not something that other people expect, especially people that haven't worked with Chinese.
So in terms of the travel experience side of the business, is that something that you think is less scalable and not something that you want to focus on in the future because of this high variability?
It's more so the market. What we've noticed is the market of very high-end travel is hard to scale. Most of the high-end, high net worth Chinese, they're very demanding and they're not very compromising.
They also probably often have their own methods of traveling or their own, at least, friends, as you mentioned before, or particular habits, and
Yes.
they're usually not first-time travelers overseas.
They're not first-time travelers, and they usually have their own thoughts about how things should be done or how they should be treated wherever they go.
Give us an example specifically.
Smoking, for example. In China, you can smoke anywhere. Outside of China, you can pay to smoke in places, people still won't let you, right?
So when you talk about dealing with such perhaps volatile sometimes customers, and this is a portion of the market that you would be targeting, especially if you're talking about mass affluent, et cetera, across China. I mean, you also have Chinese investors, do you not?
Yes, we do.
How do you deal with them? Do you see the same sort of conflicts happening?
Surprisingly, not so much. I think majority of our Chinese investors, many of them come from second-tier cities. The way that they invest is a lot different from how the Western VCs would invest. They don't require too much due diligence. They don't bug us on a quarterly basis. And usually the way that they invest is like
Guanxi related.
Guanxi related, correct. It's all about relationships for them. If they see that there's something that they can gain in the future, maybe that is sending their kids to a great internship later on, or finding their wives a good real estate that they can purchase, then that's something that they would want to invest in. If it's useful to them, not if it can actually make them money or not. Not saying that we're not doing that.
So talk about your connection to RRE Ventures and Jim Robinson.
So yes, RRE Ventures actually came in on the first round, seed capital round, and the follow-on rounds for Affinity China. Now, the interesting part with RRE Ventures is Jim Robinson. There's actually two Jim Robinsons. The third and the fourth both sit as the founding managing partners of RRE Ventures. Jim Robinson III was actually the former American Express chairman. So there's a long story that goes with it, but we actually had a talk, Jim and Christine and I and one of our other co-founders with the Robinsons. And the initial talk was based on American Express. Now, American Express, back in the days, actually tried to enter China, failed completely, and then left. And a lot of times what they said was, we don't understand the China market and we don't understand how to penetrate it. One of their insights back in the days was actually try to penetrate China using their black card. They tried. I believe the first try was actually with Bank of Communication back in the days. And it was very hard because people aren't used to credit cards back in the 90s, right? No one in China actually had a credit card. I was surprised if anyone even had a debit card back in the day. And one of his things that he said was, we've tried, we don't understand China. We especially don't understand the high net worth Chinese. And what our company, originally our platform, was to target the high net worth Chinese and actually bring American Express's black card into China.
Great. Jessica, thanks for being on Thoughtful China.
Well, thank you, Trevor.
Let's take a break to hear from William Bao Bean, who will share a thought or two about common mistakes startups make in the early stages.
Chinese startups encounter many of the same challenges as startups in the US and Europe, and some unique issues. The first is that while many entrepreneurs look at fundraising as an end goal and as an achievement as opposed to a start, from Series A to IPO, the investment round is the beginning of the next chapter. It's not the finish line. The second thing is that many entrepreneurs are all over the place trying to do too many things at the same time. Large companies have difficulty executing on more than one thing at a time, but for startups, it's almost impossible. So it's important for CEOs of early stage and even later stage companies to remember that they should be focused on one thing at a time, even if they often change what that one thing is. Finally, I would encourage entrepreneurs to think deeply about what type of company they're building. Are they in a position to disrupt a large market, or is it a lifestyle business that will make a comfortable living but not change the world? There's a negative connotation associated with lifestyle businesses, but I don't think there's anything wrong with building a strong, money-making company, retaining ownership, and retaining control. Recently, I was moving to close a Series A investment in an advertising platform company, and after explaining the various scenarios with taking VC capital, the entrepreneurs decided not to raise any money at all and focus on a slower growth, less scalable path, but with lower risk and a very good payout for the founders. So venture capital isn't for everyone. Don't get caught up in the hype.
Welcome back. With us now are Perry Chui, a partner at Steamboat Ventures, a venture capital fund affiliated with the Walt Disney Company, Gary Rieschel, founder and managing partner at Qiming Venture Partners, and Rebecca Fannin, the founder and editor of Silicon Dragon News and the author of 2 books, Silicon Dragon and Startup Asia. Thanks for coming to our studio. Perry, let's start with you. Steamboat is known as a Western venture fund, so you invest in dollars and have had a few hits here in China so far, such as YY. Can you talk about how common a hit like YY is here?
Major hits like YY is fairly rare to come by, but they do come actually in waves. From our vantage points, the first wave was probably 2000 through 2003. You see Sina, Sohu, NetEase, and maybe even Ctrip. Largely sort of Web 1.0 type of axis. The second wave is the BAT, the Baidu, Alibaba, and Tencent. They represent essentially right now the most important 3 players in the consumer internet space. And then more recently, I think it's the third wave, represented by Qihoo, YY, and perhaps VIP shops.
I think one comment, though, is that still in China, when you look at the vast amount of venture capital money that has come into the market in the last 10 years, if you look at the track record on which that money was raised, it is still very, very thin. So if you look at Alibaba, there'll be at least a dozen venture firms that will claim they had part of Alibaba. Same thing for Baidu, same thing for Tencent. And what that means is that we still don't have a real robust track record for venture capital in China, which is something that hopefully with this wave of companies like YY, Qihoo, and some of the last couple of years of companies that have been able to list, hopefully we'll start to be able to establish that on a broader basis.
Well, it's certainly not for a lack of money here. So what explains the dearth of successful hits and that track record? Because it has been already a number of years since some of those major players in the third wave that you talked about and the second wave have really made names for themselves. But in that time, in the decade between now and then, what's the reason behind having so few hits?
One thing that I have seen is the ecosystem in China has been less friendly for entrepreneurs and startups compared to that in the U.S. In the U.S., it's a much level field where you can successful entrepreneurs are not afraid of ideas being basically copied overnight, and you will be able to work in a much more friendly terms with big guys like Google or Microsoft. Things are very different here in China. These big 3 are very vicious. They first of all try to destroy you, and if they can, then they will try to buy you at a very low price.
They call them the bat, right?
They call it the bat, exactly. The bat and the bat and the bat, basically.
And I think that there's 2 elements to this. Part of it's that the ecosystem, the money came into China. Money usually leads, so the money came in before the accounting infrastructure, before the legal infrastructure, and frankly before the venture capital infrastructure was really in place to support it. So the money raced ahead, so the money then gets deployed. Well, by definition, it's going to get deployed in companies where the diligence may not have been as thorough as it should have been, and the market wasn't really ready for quite as many companies hitting the market at the same time. And I think that's part of the problem. In the States, as Perry and Rebecca both mentioned, you have the opportunity for a number of M&A transactions because a great idea, someone will pay for that great idea. Here the first question that a Jack Ma or Robin Lee or Pony Ma is going to say, they're saying, how cheaply can we do this ourselves? And that mentality is taking a very long time to go away. And that is a huge issue when it comes to the M&A exits, which in the States is the vast majority of venture capital exits, positive venture capital exits. But that has not been the case historically in China.
Do you think that will change? I mean, is this mentality because it is going to stifle innovation? And as you have the huge players constantly either buying or destroying these startups that are innovators, I mean, as you mentioned in the West or in Silicon Valley, when you look at the number of startups, and sometimes, they have these wild, crazy ideas, but they need that time to develop and to evolve. And here, if they constantly get their legs cut out from under them, you're never going to get a very diverse ecosystem.
Yeah, the startups hate the bat because they eat up all the great energy and the great oxygen that's left in the space. And they just do it themselves. So the startups are really, malnourished as a result.
But I think one thing that will change is as time becomes more important, and as more and more of the ecosystem expands, then I think that the M&A transactions become more relevant. Instagram was bought not because someone inside Facebook or someone inside another company couldn't have built that application, but it was bought because at the time with that number of users, it allowed them to leverage something that would have taken them some time and some risk to achieve. So I think as things become more time-oriented here, then you're going to see, Baidu bought PPS for $370 million. You're going to start to see some of those multi-$100 million transactions. I think there was just recently a $1.9 billion transaction that was done. So you're going to start to see real money because time will become more important than the cost savings of doing it themselves.
And Gary, of course, you've got a huge hit on your hands right now with Xiaomi, and that's garnering a lot of attention, obviously not just domestically, but internationally with the news of a recent high-profile executive also moving over. Talk about how that company's developed and what you saw in it in the early stages that seemed promising enough for you guys to invest.
Well, I think in the Series A was Morningside and Qiming, but the founder, Lei Jun, is no secret. Perry's firm invested in Lei Jun and YY. He was the founder of Joyo, the founder of Vankel, the founder of quite a number of very successful companies. So I think this was a fairly audacious bet at the time, because the idea of building another handset company in the face of HTC soaring and then collapsing, it was not an obvious move to make, especially given the amount of capital that was required. What Lei Jun figured out, and Yobin Lin, his co-founder, was they basically have cost of sales of 3%, which no one in the tech industry even comes close to. And by putting up on the website and just selling directly from the website, not going through carriers, not offering discounts, they were able to cash flow that business very, very quickly. But back in 2010, it was not obvious that they were going to be able to do that. I think that in terms of the kinds of companies you can start to see in China, that's probably the first example of a company became the fastest growing company in the history of the venture capital industry by taking advantage of an existing ecosystem and executing flawlessly. So they've had 3 years and they haven't missed a beat, and that's the reason they're at the market cap and sales numbers they're at.
And Rebecca, you kind of observe everything from a, let's say, objective and a safe distance from the battlefields, both as an author and also a contributor to Forbes. So who do you think are some of the major players who are winning right now as investors and also as companies in China?
I think the winners are the companies that got in early and established a brand and a market position for themselves. Today, getting into this market is a lot more challenging, it's a lot more competitive, and you have to have a specialized niche today to succeed. Whereas in the past, you could go in as an entry point and claim your turf. And now today, it's a lot harder. So those who got in earlier, I think, are the winners.
Now, when you have entrepreneurs coming to you and they look at your successful cases, how early or what's the right stage to approach firms like yours? Do you get entrepreneurs coming in with just an idea, or do you have entrepreneurs who really have to establish a track record and proven business model before you even talk to them? I
think for us, it varies by sector. So we have done quite a few what we'd call greenfield projects where there was virtually no revenue and there was an idea, maybe 1, 2, 5, 10 members of a team, and we were willing to support that. Typically in the internet, we would have taken that kind of risk. We probably wouldn't take that risk in healthcare. We probably wouldn't take that risk in clean tech. clean technology or environmental sciences. So I think in the IT internet space, we would skew a little bit earlier, be willing to skew earlier. Healthcare, we would probably tend to be, at least, we're not going to do the drug discovery phase. We're going to do the phase after that where it's in trial, may not be through clinical trial, but it's at least going to have some efficacy and some measurement of that efficacy. And then in the environmental sciences area, that's the area that suffered the most, I think, from the copycat, the hardware copycat mentality, if you look at solar and wind. So what we'd look for there is something in the services area, but something that would have had to have some traction. We've done greenfield pre-revenue companies in clean tech, and it's hard.
For us, we only do digital media and consumer internet, and in that space, we also try to be more essentially, since we're very much sector focused, we try to be balanced in terms of our portfolio distribution. For now, I think we're looking at more sort of Series B and C, what I refer to as early expansion, early growth phase. The company needs to have proven revenue models.
But oftentimes, I think it's rare that you run into a proven entrepreneur like Lei Jun at Xiaomi. So when a new entrepreneur comes in and they've already established somewhat of a small track record, but obviously it's not going to be something as lengthy as previously IPOing a company, how do you really evaluate here in China? Is it different than when you're looking at deals in the West, or are the entrepreneurs, do they share many of the same traits that you would see there?
I've done deals both in China and in the US. I would say when it comes to individual, especially CEOs, I think the evaluation criteria are very similar.
Which are, for example?
Number one thing, I think, is personal integrity. This person must be, you must feel you must be able to sleep tight at night knowing that you've already write this person $10 million check.
And it's interesting, there's a very simple way to figure that out, because every time you're looking at a business plan, by definition it's wrong. We've never had a business plan in hundreds of companies in 18 years that was exactly the numbers that we were presented. So by definition, something's going to be either ahead or behind, mostly behind. So when you talk to the entrepreneur, and particularly the founder, if you find yourself in a situation where he or she won't tell you unless you ask it very specifically. So if you say, oh, how's revenue? Did you make the plan? Well, we made the revenue plan. Well, they may have missed the profit plan by 100%, but because you didn't ask about the profit plan, they don't tell you about the profit plan. That kind of person is someone that we will absolutely run away from. So it's this, integrity is part of that, and that intellectual honesty, the ability to just be very transparent, because we're going to be with these folks for, on average, 7 to 8 years. And that's not the kind of relationship you want to start where you're questioning each other's integrity, or whether you're questioning whether or not someone's telling you, telling you the full picture.
Painting the full picture.
Exactly.
As opposed to spot by spot.
Right, and then the second thing obviously is his execution capability. It's one thing to put your thoughts on a piece of paper, it's another thing to turn what you wrote on the paper into reality. That's a much more formidable task. And that person's execution capability tend to be exhibited in terms of what he has done so far, whom that he has attracted, and what he has done before, and how people around him says about him, whether people who he reports to or people who report to him.
I think the other thing that we're seeing now, because I completely agree with that, the other thing is you look at how they're allocating the stock. So when the founder comes to you and they have 80% of the stock in the company, the investors maybe going to have 20%, and they ask for a pool of 5% for the employees, that's not a generous personality. That's not someone who's going to be able to attract great people. So you start out very early in the process. How are you going to share the wealth? What is your vision? And if it is the business plan where you're going to go public in 3 years, and the goal is to go public in 3 years, that's probably not something we want to get involved in.
Especially if their goal is to maintain their 80% and keep it all the way through. When you talk about entrepreneurs, though, and execution, we've seen examples in the West, if you take Mark Zuckerberg and Facebook, and bringing in, I think a critical component was bringing in someone like Sheryl Sandberg. And that was an expert move that helped stabilize, and many people would say allowed them to perhaps create some structure and create some, I think prepare them for their IPO and et cetera. And same thing with Google. Early on, they brought in Eric Schmidt, and that also helped stabilize the original founders. Is part of your role as VCs to identify perhaps a great entrepreneur, but someone who needs that experienced hand to stabilize them?
I think as VCs, there are two things that you need to be very good at. One is to identify the gaps in the team. What are the critical skills that are missing in the team, and how do you basically bring the right people and making a successful transition into the company, become an integral part of the management team. Specific at Steamboat, for instance, we've been very successful in helping portfolio companies hiring controllers and finance directors. And when the company are close to an IPO event, bringing the right CFO. And I think that's a very, very important part. And the second thing skill you need to have is finding the proper exit path for the company. Because not every company can get to successful IPOs. At a certain point, when this company is going to be more valuable for both the existing shareholders as well as the management team itself, you need to be able to find an appropriate home for the companies. That increasingly has become a great skill that VC must have.
Yeah, I think it's a good point that as these Chinese companies increasingly go global, they need to bring in outside talent to help them manage that international expansion strategy. And I'm seeing that more and more among the developing Chinese companies. InQ Mobile, for instance, just brought in somebody from Samsung and Motorola to help them run the business.
And he's now the co-CEO of the company.
And now he's the co-CEO. Yeah. I think in the past, though, that was pretty unusual, though, to have somebody come in because there was a lot of objection by the founder, right? That they didn't want to have somebody from the outside come in.
Carry that kind of title.
And carry that kind of title.
Well, look at how many successful Chinese companies have gone overseas. That's a very short list. And part of that reason is they just don't find someone that they trust. They say they don't trust them, but I think it actually comes down to the fact that they really don't find people that they can relate to, trust is part of it, but identify with, and they want to be too cheap. To be honest, it's still one of the big problems with the Chinese companies in terms of their overseas recruiting. They don't really go after the best possible person.
Right.
And I think that that's something that maybe this next wave of companies will be more successful at, but historically that's not been a great strength of the Chinese entrepreneurs.
Well, I think putting the interests of the company above whether it's the founder or the CEO's interest, that's something that perhaps Chinese entrepreneurs are still maturing at. And I think oftentimes because, as Perry mentioned, the founder is so closely linked to the company, oftentimes it's a blow to one's sense of identity and ego to say, well, I'm now a co-CEO of this company because I wasn't able to take it abroad. We've actually seen huge companies, whether it's Li-Ning and whatnot, going overseas and saying, we're making these huge expansion plans, and then sort of having to crawl back and say, okay, maybe it would have been smart if they had partnered up with a senior executive who actually knew how to help hold their hand and help that transition and help that expansion. And maybe to their ego, it would have been less damaging to actually be successful.
Yeah, and I think this is a role that the VC can play as an outsider. They can say, okay, well, I think you need this to get to the next level. And, being able to have this intermediary do this transition is very helpful.
Gary, Perry, Rebecca, thanks for being on Thoughtful China.
Our pleasure. Thank you.
That wraps it up for today. Be sure to subscribe to us on Youku, Tudo, and YouTube. You can also follow us on Weibo and Twitter and join our LinkedIn group. We'll see you again.